Hi, I'm Nicole Lorg with eXp Realty, and Jeff Quincey with Green Home Loans is back with me for another round of Q&As this month. So Jeff, thanks again for setting aside some time to answer some of these questions that I get.
Absolutely. Glad to be back.
All right, so I want to start off with another mortgage update from you on what is going on. So I heard a statement from Powell make last week. It was something along the lines of he's no longer confident that the inflation rates were heading back towards 2% target. And to me, that statement made me think that rates were going to start coming down. So what is happening out there in the mortgage industry? Because where are the rates at right now?
Yeah, so a lot of people have probably already heard rates went up over the last week and a half. We were expecting inflation to increase when the new report came out here 2 weeks ago for the April numbers. However, they came in even higher than expected by only a tenth of percent. However, kind of what you're talking about, right? Chairman Powell kind of mentioned we're no longer confident, even though we knew the inflation number was going to go up. By it going up more than expected, it's making everybody concerned that maybe that's short term going to be something that continues. And it's kind of funny to me, right? Inflation, well, consumer spending, of course, we're all spending more money. Everything's more expensive. So it does now put some pause on when these rates will be coming down. Nobody knows when. We probably realistically have moved from seeing those first Fed funds rates being cut sometime this summer. I would say that's probably pushed back to fall now. And it yet to be seen. Nobody knows. Nobody knows, right? And everybody's hanging on every word that the Fed comes out and states. So very volatile environment right now. I think the last thing to mention on that is we always see when things get worse, rates reprice for the worse very quickly. So last week and a half on Wednesday, we saw the bond market open up down 88 points and lenders open rates down or higher, considerably higher, very quick. We actually had a little bit of a bounce back on Tuesday, but lenders aren't quick to reprice for the better because they want to see if those gains stay. So it's going to be a long and slow process to see improvements to the interest rates.
Okay. Now, even with the interest rates where they're at, how are applications? Are they still increasing with the rates where they're at?
Well, current data, right? It's always lagging a couple of weeks. Mortgage applications are up, but I anticipate hearing this week or next week that mortgage applications have dropped again. We'll see demand slow a little bit with such a huge uptick in interest rates. Rates went up from that Wednesday to this past Monday. Rates went up over a 0.5%. And demand always slows down when that happens. So I expect the future numbers on mortgage applications to show a slowing. And you'll see that right on the real estate side. We see that Maricopa County's back up over 20,000 homes on the market. Goes hand in hand with a bunch of sellers getting ready for the busy spring and summer season. And then all of a sudden rates tick up and demand slows. You see that inventory number creep up. So it's something we're going to want to keep our pulse on, definitely during the month of May and going into June as well.
Right, right. And I've been actually receiving a lot of comments. I'm just sitting in my kids' activities and the parents are just talking, just don't buy right now. Prices are high, rates are high, which, prices is another topic. But, but I'm going out there. I was out there this weekend in the field and man, it's still pretty active. And then just looking at some of the homes that we had, I'm like, there's some good deals to be made out there. And these buyers that came from out of state, they're like, we're not worried about it. You have those buyers that are not worried about it because they know they can refinance. And then there's just those that are on the fence that are just trying to time that market, which is just not a good deal because the fact that there's deals out there, there's sellers concessions that can bring down that rate. It's like, it's not, don't play the market just because you just never know what's going to happen here.
It's not all doom and gloom, right? It depends. My statement doesn't change my stance of if you're in a position and can afford a payment, now is always the best time to buy because you have more leverage, right? We had numerous clients out looking this weekend, 2 of them that went under contract, another 4 or 5 that were up against multiple offers. So everything we just said, and there's still multiple offers happening at certain price points, certain areas, geographical areas. But if you can afford the payment and you can afford the house, get in now where there's less competition. because as soon as that competition picks up, prices are going to go up. And what side of the equation do you want to be on? The one that gains the equity or the one that pays that equity to a seller is the thought. Now, don't misconstrue that message to, if you're not comfortable at today's prices and interest rates, are we saying go buy a house, right? But you mentioned what you're hearing out in the marketplace, and just general consumers like, oh, it's a horrible time to buy. It made me think of a Warren Buffett statement, right? When others are fearful, buy, right? So
Yeah.
do the opposite of what the fear is pushing. And that's why people are getting really good deals right now, because there's a lot of fear, which is keeping the competition down.
Yeah. Yeah. Well, let's kind of get started with our first question, because it kind of leads into that. So I really believe that every buyer realizes that they're not locked into that rate forever, especially the first time home buyers that I'm kind of running into. And there's this thing called refinance. So let's kind of do a mortgage 101 with our first question. If a buyer has been listening to us and takes our advice and buys now at, let's just say 7.5%, and then refinances later when rates are down to, let's say, 5.5%, what does a refinance look like? And is there such thing as a free refinance, or what's a refinance going to cost a buyer? And you know what, actually, let me take
Loaded
this.
question.
Yeah, it's a loaded
Okay.
question. Let me take it a step further. Is there a difference between a buyer that starts off a new loan with you and comes back to refinance versus a buyer that's got a loan from somebody else and then goes to you for a refinance as well?
Good question. A lot of lenders out there right now. Let's first unpack what a refinance is, like you said, for first-time home buyers. So you're not locked into that loan for the entire time that you own the house. You do have the ability to take advantage of market improvements and lower interest rates, or maybe you start with a loan that has mortgage insurance, and now over time your house has gained equity and you don't need to have mortgage insurance. There's some steps we put you through versus just instantly saying, like, you got to refi to get rid of the mortgage insurance. Other options out there that we have you try first. But that is something where you can pay off the current mortgage through the process of getting new mortgage at current terms, right? And we normally see that when rates drop. We want to take advantage of that. We saw that during COVID. People bought houses at 4.25% and then refinanced at 2.75. The reason why I say your question is loaded is because there's certain lenders out there right now that are marketing, hey, come buy with us now. You'll get a free refinance if you use us in the second time. A lot to unpack. How can they do that? How do they say that? So first, I'll explain our side of the equation. Being a mortgage broker, we don't have lender fees. We don't charge underwriting, processing. In Arizona, you're going to see those fees range from anywhere from $1,500 to, I'm hearing, as high as $2,000 now. Okay. As a broker, we don't have that. So when we say come back and refinance with no charge, it's no different than when you bought the house, that there's no lender fees. Now, you're always going to have third-party fees, title company fees, taxes and insurance. You're reestablishing escrow accounts that your taxes and insurance will be paid out of. Those are always going to be a cost. Now, there are lenders out there saying, oh, we'll pay those too. Guess how they do that? Through a higher interest rate that yields them a higher revenue on your loan, so that they can then in turn give you a lender credit towards those third-party fees.
Okay.
So free means different for different lenders. Free could be that they're removing their lender fees. Free could mean that they are paying all of the closing costs, which means to do so, right? I can't go pay $1,000 worth of title company fees that aren't even mine without generating extra revenue. And the only way I do that is by offering you a higher interest rate. And then that's going to come with more revenue than I can contractually make. And my only option then is to give that to the consumer as a lender credit, thus paying those third-party fees. So be very aware of that. When somebody says we're going to do this for free, are they a broker where there was never going to be lender fees anyways? That's why you don't hear me say we do free refinances.
Right.
We have no lender costs every time you do a loan with us. And then the second thing is, am I getting a higher than market interest rate to get those third-party fees, right? Nobody out of the goodness of their heart is doing a loan for you and going and paying a couple $1,000s worth of fees that aren't even theirs, without that revenue coming from somewhere. And it's always through the interest rate. So that's the first thing to understand on that. Now, average closing cost, depending on the level of your taxes and insurance, what time of the year, like how many months are you away from that insurance policy renewing? You're looking at, with a broker like me with no lender fees, about $3,000, give or take. Now, really the net is the title fees, which are usually about $1,000 on a refinance, because anything I have to collect in terms of taxes and insurance to set up the new escrow account, you're going to get almost, it's not quite a wash, but you're going to get almost that back as in a form of a check from your current loan servicer 30 days after we close your refi. So if I have to collect $1,200 worth of taxes and insurance, you're probably getting about $1,000 back a month after we close, right? They got to close out that escrow account. All the money you've paid into it is still yours. They owe it back to you in Arizona by law. They have to cut that check within 30 days. So net is you're usually looking at somewhere between $1,000 to $1,500 in cost to refi. Now, it makes sense to roll those fees in. A lot of people say, Jeff, I'll come to the table with the $3,000. Roll it in. It's going to add at a 5 or 5.5% interest rate. It's going to add about $15 to your payment. So all we do is take the $3,000 you saved, divide it by the $15 extra you're going to pay a month. That end result of that calculation is 200. That's 200 months to break even, about 18 years before you break even. So it always does financially make sense to roll that into the refinance as long as you have the equity position to do so.
Okay, and you're talking
Does
about.
that answer? I know that was like a 3-part question.
Yeah, no, that does. So that rolling over is basically just the buyer's impound, not the title fees, correct?
You would want to roll all cost into the new loan. Yeah. Always makes sense, just because the cash that you're giving up out of your pocket is costing so little to finance that into the loan. But the chance that you're going to be in that loan for those 18 years and come out ahead by paying for it versus rolling it in, very minimal. So you end up losing money if you don't roll it in.
Okay, all right, that makes sense.
It's a mindset.
All right, well, that was a quick question and answer.
Yes.
Compared to our last. All right, so let's go to number 2. Let's see, we have residential new construction. So I saw some news coming out about new construction or builder confidence that have flattened out this month compared to last month, with permits kind of up. Now this is I believe a national stat, and not completely the case here in Arizona, because I've looked at a couple builders this weekend and they were very different as far as what they were offering in incentives. Now, what do you think is the case? Why do you think this is happening, and how is this going to affect the buyer moving forward?
Yeah, so January, February, March saw the builder confidence go up greatly. It is a stat that we follow because they're coming out of 2008. The builders out of any industry is very cautious of their building plans, their permits, to make sure that they don't get caught overbuilding. The demand's still there. In fact, the April numbers aren't out yet. It's expected that it, like you mentioned nationwide, that it's flattened a little bit. So it's expected come May that we're going to hear that the April builder confidence has stayed the same and be the first time this year that it hasn't gone up. I think it goes to what we talked about at the very beginning, right? We see inventory up, people have more options. We also see demand is down because of the higher interest rates. Now, in Arizona specifically, where we see probably that confidence level staying maybe a little bit higher, is the fact that a lot of these builder lenders have bought what is called forward commitments. They're offering some really good incentives, and that's keeping that pipeline for the builder moving along steadily. Depends on how long we go. Like, right, we're a week and a half into this new change, and it depends. Is this something we course correct in the next 2-3 weeks? Does this continue for 2 or 3 months? And then that's going to inherently change builder confidence in what they're doing, because they're going to make sure that they keep demand where it's at so that their product is continuing to go up in price. And for that, they're monitoring supply and demand to make sure that they stay even keel. If they're building 30 homes a month and they see demand go way down, they're going to pull back on that and start building 25 homes a month to keep the demand in that community up, keep prices up. Does that
Yeah,
make sense?
yeah, and well, my first thought was that the forward commitments that maybe be running out, because when I was out there this weekend, that 4.99% plus an additional some closing cost assistance, they said that was running out next month. So, and it was that particular builder, and they were going to be bumping it up to about 5.99%. So that was my first thought, is because maybe forward commitments were running out, or but
some of that for sure.
okay.
Yeah, there's some builders that have no forward commitments left. They're back to offering the same rate. So all they now have is their incentive towards closing costs, towards a permanent buy down, which is a bad use of money. But if it's not your money, it's not the worst case scenario. But I think you're right. There's some, these 4.99s are running out. They'll be bumping to 5.99. After that, they probably didn't think we'd be in this rate environment any longer. And they probably don't have any forward commitments beyond 5.99. So that probably plays a factor into it as well.
Yeah. And even my buyers were just kind of like, well, if now I'm in a rush to find something within May so I can get that 4.99. And if is it worth it? Because your upfront costs of blinds, your landscaping, possibly pool, ceiling fans, all of that. And you're not going to get that 4.99. Is it really worth going to a new build at that point? When if you do resell, all of that's included and still possibly getting seller concessions to buy down your rate when they're already expecting to refinance it in the future. So there's that equation of just that, okay, weighing it out to look and kind of zooming out and seeing the bigger picture of new builds versus resales.
Yeah, a lot of people think I'd be biased because when you go new build, we can't compete with those forward commitments. We can't compete with the builder incentive because you only get those if you use the in-house lender. My unbiased opinion is new builds aren't the shiny object they were 20 years ago, right? Everybody's probably seen the picture floating around social media of what lumber looked like. I grew up in a lumber yard. My dad ran one for 30 years. And it's no joke what the lumber looks like now compared to 20 years ago, right? You show the rings on the end of the 2x4, and that signifies how old and how strong that lumber is. They're just not built the way they're building them faster. I have friends who are home inspectors that are going and doing, new build inspections, which the builders hate. And I have one inspector, he goes, every time I get hired to do a new build inspection, I go up, I do head and shoulders in the attic, and every single one of them has a rafter cut out to fit the HVAC equipment up there, which is totally not something you want on this load-bearing roof. There's a reason why rafters are needed, just as an example. But you're right. The number one thing I see as a lender is you buy a new build with the builder lender. They come back to me a year or two later to refinance. And they have and I tell them one of the pitfalls is landscaping, especially today. It's way more expensive. So when they come back to refi, I say, hey, just out of curiosity, have you landscaped the backyard yet? 100% of the people, it is no. It is a dirt lot. By the way, now can I take cash out of my house to pay for the landscaping we haven't done yet? So now they're in a worse position, owing even more on this house. So there is some truth to buying. All of this stuff is overinflated, right? Everything at a design center, the landscaping, everything you do through them is inflated compared to buying resale. Think of it as a car you buy off the lot brand new versus one with 10,000 miles on it. Who took the depreciation on that, right? The second buyer, not the first. Or the first buyer took the hit on cost. The second buyer got the benefit of the depreciation. That's what happens with new builds. There's pros and cons to both. You just got to make an educated decision.
There is. And, thanks for bringing that inspection up because like you said, the home builders do not like you bringing in your own inspector. And, your agent's going to definitely advise that to have the inspections, whether at the end or in different stages of the build. So be sure to bring in an agent to represent you in that entire transaction, entire build time, because there's a lot of
100%.
all right. So let's go on to question 3. Now, this question came up from our last conversation last month, and they're like, what does Jeff mean? So Jeff, you made a comment that we should contact the lender prior to paying off credit cards if we are trying to get pre-approved for mortgage. Why is that? Why wouldn't we be able to afford more if our debt to income level is zeroed out?
Perfect. So your listener took that, and keep in mind, every time we talk and do this, it's not all black and white, 100% one way, but the listener's correct on both. Paying the credit cards off does allow you to qualify for more because you improve your debt to income ratio. What we were talking about is in terms of the best use of your funds, trying to increase your credit score. Okay. So I'm going to give you a perfect example. I'm glad this question came up to drive home the point. So down to zero payment is going to positively affect your debt to income ratio. But if you're also trying to positively affect your credit score, we just had a client last week that I ran an analyzer on. She has a $2,000 credit limit. She had a balance of $1,200. Well, the standard is you want to be under 30% utilization. So if I didn't have an analyzer system, I would be telling that client to pay her debt down to under 600. If I had a debt to income ratio issue, I'd then be telling her to pay it to 0. Well, the analyzer said to get the biggest impact to her credit score was to pay that credit card down to exactly $217. Okay. So she could pay it to 0 or 217. Both have different outcomes. 0 is going to help her debt to income ratio, but it's going to hurt her credit score increase, where the 217 is that analyzer saying, based on the entire makeup of your credit report, this is the exact number that that credit card should be paid to. Now, my advice, once you're in the home and we've gotten you the best possible mortgage, that advice is out the door, and I flip to pay off all your debt, be debt free. Always, and right, it's a financially responsible thing to do. So hopefully that clears that up. That's why we want to look at it, because if you have this pocket of money, maybe it's a tax refund you just got, and you're looking to benefit your credit score to get lower interest rates, right? On today's mortgages, an eighth lower interest rate could be saving you anywhere from $30 to $60 a month, depending on the purchase price, right? So does it make sense to pay a credit card off in full that has a $25 minimum? No, the lower interest rate's going to help your budget even more than paying off the credit card. So that was the purpose of check with a lender in terms of getting the optimal credit score. Once that's done, yes, paying debt off 100% is a goal.
Good deal. Okay. Hopefully that answered it.
I try not to talk in absolutes for this reason right here, but there's so much stuff in my industry where, right, my one answer to this consumer could be completely different to the next consumer based on their situation. So yeah, important to know. You don't want to go do stuff like that blindly. We had another client last week that had a good chunk of money and said, I'm going to pay everything off. And I said, hold on. Cash is going to be king in the sense of putting down payment down. You go pay all of that and it doesn't change your credit score and you're already approved for what you want. But now maybe you're negatively impacted on your payment because of how we used the cash. So hopefully that helps bring some clarity.
So our question 4 has to do with down payment. So this one says, this person said, I've always been told to never try to buy a house without having that 20% down payment, which will eliminate the PMI. However, is that really the case now? And I hear this a lot from the first-time home buyers, especially when it's been drilled into them that they need that 20% down. Yet they're conventional. You can come in as little as 5%, FHA 3.5%, VA 0. So, speak to that one.
Yeah, so 20% is always optimal. Yeah. Okay. I'm gonna answer this question with a scenario from about 2 years ago. A young couple buying their first house, and they'd set themselves up making good money, saved a ton of money, had the ability to put 20% down, no problem. But commission sales job, a little nervous about where his job was going. And we talked about 20% down was going to be about $120,000. Okay. And I really have 2 ways to break this down. So first one is his story, $120,000 to put down, and he had about 180 saved up. But 5% down on that house was going to be 30 grand. So it gave him $90,000 of feel good sitting in the bank with the mindset that he's going to refinance at some point in time when rates come down. Well, if that house appreciates, it was a $600,000 house, if that house appreciates 10%, that's 60 grand. So if he buys with 30,000 down instead of 120, that's a $90,000 spread. And then the market appreciates 60 grand. He can now at time of refi come in with 30 grand. In the meantime, he made himself feel more comfortable with extra assets available. But now he got to a 20% equity position with only $60,000 of his own money instead of 120. Obviously, there's a lot of what ifs in there. The second thing is, and when I have people say that, have 10% saved up, I really want to save the extra 10% to get to 20% down, not to pay mortgage insurance, which 100%, you want to avoid mortgage insurance at all costs if you can. And my first question is, how long does it take you to save that up? If you want to buy a $400,000 house, that's $80,000, and you have $5,000 saved now, my first question in our initial call is going to be, how long is it going to take you to save 75? And most clients don't know. So I'll say, well, how long did it take you to save 5,000? Well, it took me 2 years. Okay, well, that is going to take you 150 years to save up the other 75. But let's just say, based on new job, new income, you can get there in 5 years. And now you have the 20% to put down. What happened to the real estate market in that 5 years? History shows, other than one little blip in 2008, it's going to go up, right? So if that $400,000 house is now 500, now you need 100,000, not 80. And that means like if that happened, you just lost $100,000 in equity waiting to get to the prime spot. Does it make sense to pay $100 a month in mortgage insurance to be the one that gains $100,000 in equity position in the house in appreciation?
Mhm.
So never a right or wrong answer on that as well. But I like to just spell out the math. The math tells us what we should do. And there's always a lot of variables and what ifs because we don't know what the market's going to do, right? We can only project what we think.
Now, at some point, if they decide to refinance, is there a way to eliminate that PMI during the
If they're in a conventional loan, yes, with 20% equity position. If they're in an FHA loan and they're refinancing back to FHA because of credit score, that's why when we help somebody buy a house with an FHA loan, they're going to have mortgage insurance on the life of that loan. So my goal isn't to get them in the house. My goal is once they're in the house, what do we do to get the credit score up so that when they come back to refinance, we're not enticed to go back to FHA because now you're going to have mortgage insurance for the life of the loan again. Unless you have an equity position, then it could be 11 years, which is still a long time to pay. So we're working with, helping establish a higher credit score so that when it comes time to refinance in a year or two, we can do the refi over to conventional. Even if they're not at 20% equity position, that mortgage insurance will be very inexpensive. And now with conventional, if you start with mortgage insurance, there's always a date that it will automatically fall off without having to do anything. So that's kind of the natural progression of how we look at that.
That's good to know. I mean, because not just the whole refinance part is to get a lower mortgage rate, but also just the possibility of just eliminating that PMI there. I
Yeah,
don't think I know that as well.
right. If somebody's wanting to save up for 20% down, my opinion is get into the real estate market now. It's only going to go up. The question is by how much. And then let's say you're ready to refinance and the market's only appreciated 5%. That's still 5% less money of your own you had to find and come up with and save, right? Get into real estate now and continue that same path of saving, that same goal, and be ready to bring money into the refinance to get to a 20% equity position. Now, we won't get into it today, but there's many more calculations I then do to determine, does it make sense to bring that money in versus, as a broker, we have access to some very discounted mortgage insurance where, I can probably show a 10-year break even point on not bringing that money in and instead going investing that and getting a 7 or 8% return in the market. So,
Okay. Okay.
so that's something we look at. Math always answers what we should or shouldn't do.
Well, that's all the questions we have for this time around. We only had 4 this week. But Jeff, you still putting on your home buyers class that you had last week. So how's that going? How are your buyers responding to that?
It's been going awesome. We've had great turnout. We already have 3 buyers that have closed on their very first house. We have 2 more in process, and we'll see what comes, right? We just had the last one last Wednesday. We'll see what comes out of that. But what we're finding is people are gaining more knowledge and just some confidence about that this doesn't have to be a scary process. Or me as the finance guy, right? A lot of people are just scared about the person they're talking to, judging them, and we don't do that. We're just here to help. But we still do it third Wednesday of every month at 6:30 p.m. on Zoom. I know Nicole always shares the registration link. It does require a registration process, and then you'll get the week out, the day before and the hour before notification to remind you. Do those every month like clockwork.
Yep, and you can watch or listen to it in the comfort of your home. All you're doing is seeing Jeff on the screen.
Yeah.
Nobody else, and you can submit questions along the way as they come up. So, and Jeff will, if he has the time, he'll jump in and start answering those questions as well during the class. But definitely very informative. I would definitely recommend. Now, is this just for first-time home buyers, or can second time around, third time around home buyers join the class for more information?
Yeah, good question. So we have had people who have bought houses before show up. I think it's always good to get the knowledge. Unfortunately, doing this for over 20 years, I still get clients, I take a very educational approach to my job as it is. And I will still have that initial phone call where they bought and sold. And I don't just assume they know everything because unfortunately, a lot of loan officers are order takers. So they just, oh, you have great credit. You're putting 20% down. Here you go. And it's not uncommon that in a 10 to 15 minute phone call, initial call, I will have clients say, I've learned more in 10, 15 minutes with you than I have in buying and selling 3 or 4 homes. So I don't think when it comes to educating and gaining knowledge, I don't think there's anything lost there. We call it a first time home buyer class, but good knowledge for anybody to have.
Yeah, and I can definitely, just add to that, because every single one of my clients that I've sent to you, they've had that same comment come back as I've learned something new. He's very informed, breaks it down. He goes, he's great. He's great at what he does. So
That's always my goal.
yes, absolutely. So I would definitely recommend at least attending the class, see what, what information he has there. Probably going to answer a lot of your questions. But if you have any questions for Jeff and are thinking about trying to get approved this year for a home or trying to purchase this year, definitely reach out to him. I will leave his contact information below this video, as well as the link to his video for next month's class. Now that link doesn't change from what Jeff's saying. So you can sign up for next month's class. And then once that one's done, you sign up for the following month as well.
Sign up for anyone you want. There's a drop down that will show all the scheduled ones. And yeah, would love to have anybody. Nicole, thank you so much for having me again. Everybody keep bringing the questions in. I'm loving this. We hear something different every time.
Yes, yes. So yeah, again, if you have any questions, please send them over to Jeff or myself, and we'll be sure to cover them on the next Q&A for next month in May. But again, thank you for joining us, and we will talk to you soon. Have a great day.
Thanks, Nicole.